If you're looking to take cash out of your investment property and you want to know all the details, like the guidelines that the underwriters use to determine whether your loan is going to work or not, then this video is for you. So who this video is not for are people who are thinking about buying investment property, or just want some general sort of salesy stuff about get rich quick buying investment properties. No, who I'm talking to are people that have 1, 2, 3, 4 rental properties. They have a lot of equity in them. They're trying to figure out if they can get cash out, how much cash they can get out, what's the best type of loan for their particular situation, etc. So let's just get into it. So I have some notes here so I don't miss anything. But the first thing to know is about taking cash out of an investment property is the maximum you're going to be able to get to is about 75% loan to value. So in other words, for easy math, if you have a property worth $100,000 and you want to take cash out, you could get up to a $75,000 mortgage. Now, if you already have a $50,000 mortgage on it, then of course you're going to have to pay that mortgage off, and then you can get another $25,000 in cash, minus of course the cost of the mortgage. Excuse me, this cat is not working with me on this video. So anyway, and also if you have, say, a duplex, quadruplex, then you're probably going to be capped at about 70% loan to value. So there are going to be, different things to think of there. Now, what are the benefits of a fully documented loan? And first of all, I'll say there are also things called DSCR loans. You've probably heard of those if you're a serious investor. That stands for debt service coverage ratio. And basically the way those work is there is no income documentation. The only thing that they are looking at is the cash flow. So in general, if you have what they would say is a 1 DSCR ratio, that would mean that your mortgage payment is no more than the fair market rent of the property. And sometimes that can go lower. If you have a lower loan to value, it could be 0.75. So actually the mortgage payment can be higher than the fair market rent. Now, the difference between a fully documented loan and a DSCR loan, beyond this just being easier, is that the interest rate is typically going to be a little higher on the no income documentation loan. How much higher really depends on your credit score, of course, and what the loan to value is. But for a fully documented loan, which if you only have 1 rental property and you don't have a loss on the property, everything else looks good, maybe 2, 3 rental properties, this could be the best way to go. The interest rates on investment properties and second homes are always going to be higher than it is for primary residence. A couple years ago, Fannie Mae and Freddie Mac changed how they price second homes and investment properties. Basically, they don't really want to be in the investment property business, although they do those. Their primary mission is to supply homes to people wanting to live in them as their primary residence. But they just made the pricing much worse. In other words, the rate's higher. So again, depending on the loan to value and the credit score, it depends. It's going to be higher. But what are you going to need? So on a fully documented investment property loan, what makes it difficult is there's so much paperwork. So you're going to have to, in addition to supplying your tax returns like you would with a normal loan, 2 years of tax returns. If you are employed by a company or whoever, you're also going to, of course, have to supply the last month's worth of paycheck stubs. You're going to have to supply the last 2 months of bank statements. And then for the investment properties, for each property, you're going to have the mortgage statement. You're going to have the most current homeowner's insurance bill, and or declaration page is what they would say. You're going to have the real estate tax bill, and you're going to have the most recent HOA bill, which can be hard to get sometimes because a lot of times they don't generate an actual bill. They just send an email, hey, the bill's due. So that makes it a little bit hard. But you can get through it. I'm also going to put up on the screen here for a minute. This is the Excel spreadsheet that an underwriter uses to figure out the income cash flow, I guess, from an investment property for a fully documented loan. And you're going to see that in the top cell, it's going to have all rent received for the year. Well, then you have to subtract all the expenses. So whatever expenses you had, that makes your tax bill lower, they're going to have to be taken off of that. Now you can add back the depreciation, which is great. You can add back the mortgage interest. You can add back the homeowner's insurance, taxes, etc. But then at the bottom, whatever that number is, you're going to still have to subtract the monthly PITI, principal, interest, taxes, insurance, and HOA dues. So it's very possible that you could have a loss. So many times it seems like I'm having a conversation with a borrower and they say, hey, I've got an investment property, the mortgage is $1,000 a month, I collect $2,000 a month, I have $1,000 in cash flow. Well, in the real world, maybe you do. But as far as a mortgage goes, that could easily be a loss. So that's something to watch out for. Now, that might be one good reason why, instead of doing a fully documented loan, you either have to or you want to do a no income documentation or DSCR loan. Now they're going to have their own guidelines. And I'm a mortgage broker. I have access to, 100+ different banks, investors, and so forth. And a lot of these companies that do the DSCR loans are going to have different guidelines. And sometimes we just have to find the lender that meets those guidelines. And everybody thinks that they have a very simple situation, but they're not. So for instance, right now I have a couple, now they didn't think it was a simple situation, but they have a property out west. It's paid for. It's worth about $650,000. They have a property in North Carolina as well. Now, they bought the property in North Carolina to also be an Airbnb, but then the big hurricane came through, ruined the tourist season, and basically they're having to live in that home as their primary residence because they're retired, they have a very modest Social Security income, not near enough to qualify for a loan. And on top of that, one of the two borrowers' credit got messed up because of the disruption in the rental income, and their plans got screwed up. So on top of that, they own this property in an LLC. So you have two members that own a property in an LLC, 50-50. One's got bad credit, and they can't fully document the loan. Well, what we did is we found one investor out of a couple that would do this. They will take one member of the LLC, leave the other member off, and give them cash out on the loan, even with not a great credit score. So it was a 630 something. So obviously the interest rate's not great, but that's a situation where a loan like that's perfect for, because they're able to meet their short-term needs where there's really no other way to get that equity out of the property without selling it. So as you can tell, there's a lot of different things to take into consideration when you're thinking about getting cash out of an investment property. And sometimes it's not so straightforward. So if you found this video helpful, it helped me a lot if you hit like and subscribe. If you have any questions, put them in the comments below. And if you need to get cash out of your investment property, go to my website, mortgagesbyscott.com. You can fill in a form to contact me, or you can just click apply and fill out an application, and we'll see what we can do. So anyway, thanks for watching. Hope you found it helpful.